What is hedging ratio for commodity futures? Imagine you're holding a large amount of wheat and worried about prices dropping before you sell. How do you protect yourself from that risk? That's where the concept of the hedging ratio comes into play. It helps you figure out how many futures contracts you need to buy or sell to guard against price swings. The hedging ratio is the proportion of the size of your futures position compared to your actual physical commodity. If you own 10,000 bushels of wheat, and each futures contract covers 5,000 bushels, then you might think about using two futures contracts. But the exact number depends on the relationship between the futures price and the cash price of wheat. This relationship is key. If the futures price and the cash price move together perfectly, the hedging ratio is 1. That means for every dollar change in the futures price, the cash price changes by the same amount. So, a hedge ratio of 1 indicates a fully matched hedge, where the futures perfectly offset the cash price risk. But sometimes the futures and cash prices don't move exactly together. If the futures price changes less than the cash price, the hedge ratio is less than 1. That means you need fewer futures contracts than the size of your physical position. Conversely, if futures prices tend to change more than the cash prices, the hedge ratio is more than 1, and you need more futures contracts to cover your risk. To find the best hedge ratio, traders often use a method called regression analysis. They analyze historical data to see how much the cash price changes in relation to futures price changes. The slope of this analysis gives the hedge ratio, which minimizes the overall risk of holding both the physical commodity and the futures contracts together. In practical terms, if you are hedging a specific amount of corn, like 5,000 bushels, and one futures contract covers the same amount, you might start with a hedge ratio of 1. But if you're cross-hedging, say with a related commodity like soybeans, the ratio might be different because their prices don't move exactly in sync. The hedge ratio also helps reduce basis risk, which is the risk that the futures and cash prices don't move perfectly together. Adjusting the hedge ratio allows traders to fine-tune their positions to better match their actual exposure. Whether you are protecting against falling prices by selling futures or guarding against rising prices by buying futures, knowing your hedge ratio is essential. It guides you on how many contracts to use, making your risk management more effective. In summary, the hedging ratio is a vital number that tells you how much of a futures position you need to take to protect your physical commodity holdings. It's based on historical price relationships and helps you balance your risk and reward in commodity trading.